Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 292 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Yeah, I missed a week, and it was quite eventful for the markets, was it not?
Yeah, it's been an eventful couple weeks. Some really, really bad, some really, really good. Some things in between. So yeah, it's hasn't been there hasn't been a shortage of news headlines and talking heads throwing out their opinions on if the market's doomed forever or if there's going to be a rip your face off rally to the upside. So
I missed that term. You'll rip your face off.
Yeah.
Rally.
So you missed quite a bit last week. Yeah,
it seems so. I was thinking, preparing for the podcast, and some of my opening comments just takes me back to the beginning of the year. I think we felt relatively confident that market volatility was going to rise this year compared to last, just with the change of administrations, right? And change of some of the policies, everything from regulations to trade, et cetera. I think even though that opinion we have is not exclusive to us, it's a little more universal that people thought volatility was going to go up. I think the magnitude and the quickness and how volatility just came up in February and March took a lot of people by surprise. And it felt worse than it actually did because we haven't had an occurrence of this pretty much since last August.
Right.
And last August, I don't think was as bad as we've experienced recently, and I will get into that in a couple of minutes.
Yeah, and I don't know about you or Taylor or Aaron, but when I was doing my client meetings over the past couple of months, I was previewing to people, hey, we think that at the end of the year, stocks are going to finish in the green, but we do think there's going to be more volatility throughout the year than there was in 2024, and specifically was telling people that Q1 of a post-election year tends to be pretty bad.
Yeah.
So, it wouldn't surprise me if the first quarter was not good or not fun. And I think part of that has helped, I've always, I have friends and family that, usually reach out during times of volatility for the market and say, hey, what's your thoughts? And the next question is, I'm sure you have clients calling you all the time. And yeah, we've had a few, but
sure.
I think because of us getting out ahead of that, has helped with that. And people know, hey, my guys told me that it's probably going to be rough sledding for the first couple of months of the new year. And that's exactly what happened. I'm not saying we get it wrong all the time, but
sure.
At least, talking about that stuff in advance helps when the volatility does come.
I think that's a good way of saying it. If you go to sleep on January 1st and wake up on December 31st, and you miss a lot of the short-term drama like we've experienced lately. And it's a reminder that in order to get stock-like returns over time, you have to endure periods of corrections, sell-off, volatility, fill in the blank. There's no free lunch in the market. And what happens is, anytime you have volatility to the upside or downside, the two main guiding emotions of investing come back into play, fear and greed. And what's always not surprising to me, but surprising to a lot of investors, even though who've been in the markets for a while, is how quick those winds can switch from one to the other. So we are in the depths of fear over the past 3 or 4 weeks. It appears as if that can't change anytime soon. And lo and behold, history repeats itself, and you would be amazed how quick we go to greed. And I'll be on the podcast. I will remind our listeners and viewers that I said this at the end of March. It's crazy how people, a lot of investors get gripped with that fear, and the guiding emotion that humans have is that this is going to continue and not end.
All right.
And I think that just causes individuals to make those kind of knee-jerk reactions. I'm going to do this. I'm going to de-risk. Going to make me feel better. I'll get back in when things have calmed down. And what do we see time and time again, Mark? They get back in when prices have recovered. And so I just want to just end it with this comment. We have to remember that when we are in the equity markets, that's not money that you need in the next quarter or two. We have to have realistic time horizons, and we have to continually remind ourselves, corrections, sell-offs, that's part of the deal. And if you try to time the market and you miss those 5 best days of the year, the 10 best days of the year, and they tend to happen when the market's not trading, your returns are going to be severely diminished. Well said.
Yeah, good way of saying it. Before we get into it, who did you choose to win it all in your bracket for March Madness?
So it's interesting this year. My 13-year-old, this is the first year where we've had an active debate on my bracket specifically. I've been targeted. And first of all, he thinks I'm insane that I don't have Kentucky and Clemson going farther than I do.
Interesting.
Pretty much ridiculed me last night. And I was actually kind of proud between you and me. But I have Florida going all the way.
Okay.
I got Florida going all the way. I had the finals being Florida and Duke. What about you?
Yeah, I have. I believe it's the same. I have Duke and Florida in the final, but picked the Blue Devils.
Interesting.
So,
what's some of your dark horses, like your major upsets? Like, could you have anyone go into the Sweet 16 that there's like no way people would ever imagine that?
Yeah, I was. I was looking at like the games because they start today. I think Yale. I think they're a 13 seed.
I picked them in the first round.
I think Yale could be a sleeper team. High Point plays Purdue.
I've actually picked High Point.
Okay. VCU's an 11 seed against BYU, and
that's my dark horse to the Sweet 16.
Really?
Yep.
Okay. So being in the A10, which is just so disappointing that Dayton goes to their house, beats them in the last game of the year, and then Dayton rips our heart out by losing in the first or the quarterfinals of the A10 tournament.
I know.
Which was their first game.
Rough.
So I won't go too deep into that, but yeah, Yale plays Texas A&M. Yeah, I again, and I'm not really a huge college basketball follower outside of Dayton, but Colorado State plays Memphis.
Memphis on that one.
UNC's an 11 seed. It's always dangerous.
I'm like most people. I'm negative on UNC right now.
Yeah, and Troy against Kentucky. I think Kentucky usually can get themselves into trouble in the first couple rounds of the tournament, and then maybe I think my big dark horse is the Akron Zips against Arizona. So
I also have Akron winning that game, by the way.
Akron is a 13 seed against an Arizona 4 seed. So
I also have picked.
Yeah,
Akron.
again, I'm not a basketball guy, so I just like to listen to the talking heads before the tournament and see what their opinion is. Who did you pick, Jenna?
Yeah, let's see who Jenna picked.
Winner.
I have one bracket for Duke to win and one bracket for Florida to win, and I have
One bracket for Duke
to the Sweet 16.
and one for Florida. VCU going to the Sweet 16. Got it.
I like that.
We'll have to come back next week and see how the first 2 rounds went.
Yeah, we have a bracket competition here at the office at Jessup Wealth Management, which is always fun and contested.
It is. It is. So, but anyways, before we get into this week's show, listeners, if you've been enjoying the Independent Advisors podcast for a while now and want to take the next steps in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com. Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy once you land at jessupwealthmanagement.com. Just click the Schedule Initial Call button and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y Charts and as of the market close on March 19th. S&P 500 index down 4.7% for the month of March and down 3.5% on the year. The Dow Jones Industrial Average down 4.3% for the month and down 1.4% for the year. The NASDAQ Composite Index down 5.8% in March and down 8.1% for the year. The Russell 2000 Small Cap Index is down 3.9% for the month and down 6.6% for the year. And the Vanguard All World Ex United States ETF is up 3.9% in March and up 9.7% on the year. 3-month Treasury rate at 4.33%, the 2-year Treasury rate at 3.99%, and the 10-year Treasury rate at 4.25%. Moving on to big headlines, current events from the week. Federal Reserve held interest rates steady at a range of 4.25% to 4.5% on Wednesday, March 19th. This decision reflects the central bank's cautious approach amid uncertainties surrounding the economic impact of recent policy changes. And this decision to maintain current interest rates reflects, in my opinion, sort of a careful stance in response to the evolving economic conditions and policy uncertainties. Any comment on the rate decision?
I mean, this might be a hot take, right? But at the end of the day, if the Fed was really concerned about the economy, they'd be cutting rates. Mm-hmm. And, a lot of the talking heads aren't going to stick their neck out there and say that, so I'll say it.
Yeah, and I think I think the market would have reacted differently if they did cut rates yesterday.
Yeah, that's right. Well said.
Because
if they would have cut, then what would have been the narrative?
Well, yeah, because they were, at this point where it was just recently they're in this holding pattern. And if all of a sudden there's an unexpected cut, I think going into the meeting, there was like a 98% chance they were going to hold rates steady. And if they cut, everyone would be like, well, we got this wrong. They know something
Fed know that we don't know.
Yeah. The economy's weaker than we all think. So, markets reacted nicely up, between 1 and 1.5%, depending on which indice that you look at. So I think it was, at least for right now, with the current volatility we've had, I think it was the best case scenario.
Helpful.
Next, the Tax Cuts and Jobs Act of 2017 is set to expire at the end of the year. The administration is already discussing how to extend this piece of legislation to maintain the lower tax rates put in place several years ago, also by President Trump and his administration in the first term. So we will continue to provide updates as those comes along. But with the way the political division is in Congress right now, it wouldn't surprise me if this is a priority, just based on the pure numbers that the administration has on their side. So
yeah, my personal opinion on this is I think it'll be a Q2, worst case, early Q3 priority. Is just taxation in general and how Congress kind of tackles this. And setting personal political views aside. I think it's very obvious to a lot of people, including myself, that the administration is going to try to use whatever momentum they have to put forth the policies that they have, right?
Yeah.
And they had the momentum right now.
Yep. First thing that I had was a post on X from Jason Gepfert on March 17th. So again, Jenna will post all of these visuals to the YouTube video and in our show notes. But Jason said the S&P 500 just recorded its second straight day with 90% advancing stocks after hitting a 6-month low. And And it shows the performance when this has happened in the past of the S&P 500. But before I get into the numbers on that, I just want to clarify when Jason says 90% up days, a 90% up day is when 90% of the total volume and the stocks in the S&P 500 are positive, meaning there's
broad.
90% of stocks are going up, 10% are going down or staying flat. So it's broad. Market participation, right? Mm-hmm. So usually these are tracked by people that help identify major turning points in the market.
Well said.
You tend to see this stuff, near tops, near bottoms. You don't usually see this type of stuff in a normal, like 2-step forward, 1-step back type of market.
Uncommon to see this occur.
Right. So, so there were 17 signals going back to 1938. So not the smallest sample size, but not the biggest.
I'll take that sample size.
And every time this has happened since 1938, 2 months later, the S&P 500 was higher 100% of the time for a mean return of 6.2% over the next 2 months, which is pretty strong. The next 3 months, higher 94% of the time, mean return of 6.5%. And then 12 months later from this occurrence, stocks are higher 88% of the time with a mean return of almost 12%. So,
and it looks like the data sets that are making that number not higher on the positivity percentage is around 1929 to 1930.
Yeah, which we had some garbage going on.
We had a lot of issues
back then. So I thought this was really interesting. Jason does a good job of sharing things from the site Sentiment Trader that has a lot of back testing capabilities and indicator features like this. So thought that this was very interesting. But I think, after having the past couple of weeks that we've had, it's very welcoming to see this type of action.
I love it. And I got some more just to add to this in a little bit.
Okay. Second thing I had was the most recent magazine cover from The Economist. So for those people who are just listening to the podcast, The Economist magazine cover for the first half of March is a picture of President Trump, and I don't know if you've seen this yet, Matt, standing on a pile of cash, holding a gasoline container in one hand
and a smoldering bill
and $100 bill lit on fire in the other hand. And the wording on the magazine cover is the revised economic outlook. So again, for newer listeners of the show who may not have heard us talk about this before, going way back to, the mid 1900s, the magazine cover indicator is a sort of a contrarian stock market signal that suggests when a financial trend or market sentiment becomes so popular that it makes the cover of a major magazine. It's when it's the hot thing.
That ship has sailed, right?
Yeah. So, and in the past, these magazine covers have tended to come out near turning points in the market. So to me, and my interpretation of this is that the majority of people are extremely bearish on the economy and the market. And in the past, it's proven to be a handy contrarian indicator going forward over the next, say, 6 to 10 months.
Did you look at my show notes?
I did not.
Okay.
No. So again, it doesn't for sure mean, oh my gosh, the bottom is in, but I found it interesting that I also discussed something similar to this last quarter. I can't remember if it was October or November, I think it was. We had a magazine cover that came out that painted a picture of the US dollar as a rocket ship that read the envy of the world, right?
Yes, I remember this.
And then
now.
since then, stocks are down and the dollar has gotten crushed, right? So, do with it as you please, but I just found it pretty interesting that we now have another magazine cover that doesn't have a great outlook.
I could just envision Jenna coming up with like a once a quarter graphic for our YouTube video. It's like Mark McEvely's magazine cover indicator. She puts some music behind it. I could just see this becoming a thing.
Yeah, it's it's just one of those things where, like anything, like you said, when something becomes to get too mainstream, most of the money's already been made or lost depending on what's going on. And, I think back to, when marijuana stocks were on fire,
sure,
right? Everyone was talking about that.
Pun intended.
Right. Yeah, right. They were lit up for a short period of time.
I guess just to build on that, because I think it is an important point I want to make here is When you see such quick and dramatic sell-offs and you see positioning get as extreme as it has been compared to where it was just 5-6 weeks ago, what tends to happen, and this is going to sound very crude, but people in essence are either buying protection or they're selling out of the market. And my analogy is this: your house is already on fire and you're calling State Farm for coverage. Mm-hmm. It's a little late for that.
Yeah.
Usually. Yeah. So that's my 2 cents.
Right. It's a good way of saying it. Okay, last thing I had was a post on X from Ryan Dietrich on March 13th. Ryan says, bear markets per decade for the S&P 500 based on when they started. In the 50s, we had one bear market. The 60s, we had 3 bear markets. The 70s, we had 1. The 80s, we had 2. The 90s had 0 bear markets. The 2000s, 2 bear markets. 2010s, 0. And 2020s, 2. He says, could we really have a third bear market this decade? Anything is possible, but we've never seen 3 bears start within 5 years of each other. Again, not saying it can't happen for the first time this time around, but the probability is very low. That's a lot of bear markets to have within a short period of time.
Good way of saying it. You look at the lens of history, this would be unheard of.
Yeah, it'd be on average we'd be going like a year and a half, maybe a little more than a year and a half with 3 bear markets. And it's again, not saying it can't happen, but I think the probabilities are low that does happen.
Well said. By the way, you've melded perfectly into my show notes.
Let's keep it rolling.
All right. First piece is from Seth Golden, friend of the podcast. He was referencing some research from Tom Lee. He's the founder and principal at Fundstrat. We've had a very quick correction, Mark. So let's put this into context. This is this piece from Tom Lee, and what it shows, and this data set will go back to 1950. Okay? It's a pretty long time period, would you say? Mm-hmm. This is the 6th quickest 10% correction in the S&P dating back to 1950. Okay? So some of the other times where the amount of trading days it took the market to lose 10% in the S&P. Number 1 is 8 days at the onset of COVID in 2020. 13, remember those days. 13 trading days for a trade war during Trump's first administration. 18 days back in the mid-50s regarding Eisenhower heart attack. 17 days Korean War, early 50s. The Volcker shock in the late 70s, 79, that's 20 days. Asian financial crisis, late 90s, that was in 97, that was 20 days. And what just happened? 20 days. Mm-hmm. And so when you look forward in those other data sets, the average return 3 months later is over 8%, 6 months later over 15%, and 12 months later about 20%.
Yeah.
Do with that data set as you will. Pretty quick, I think, given the narratives. So let me keep building a picture for you. You ready? My second piece, bearish sentiment is a bit extreme, and that is an understatement. So let's put some data behind this. The AAII survey, I think, is a good piece of research to look at. Why? It's a simple question. You can only have one of 3 answers. Are you bullish? Are you bearish? Or are you neutral? They do it every week. And then they build the data set going back to the late 80s. Well, when you look at this data point, you now have had over 3 consecutive weeks where the indicator came in above 60%, where at least 60% of the respondents have answered as bearish. Now, I got to put that into context for our listeners. So this chart will do it. Looking back since the late 80s, and a quick kind of eyeball mark, how often have respondents said bearish at a 60% number?
Looks like going back to the late 80s, this is only the 4th time.
4th time. 4th time is correct. And the other time that in recent history that it got this high was the global financial crisis, the GFC. So sometimes I feel that because the proximity of the GFC is far away, we lose perspective as to how bad things truly were back at that time. So I'm going to take you down a walk of memory of what really was occurring then. You ready for this?
Yeah.
Let's go on this journey, baby. 2007, the prelude. In April of 07, you had New Century Financial, a subprime lender, files for bankruptcy. June 2007, Bear Stearns collapses. August 07, BNP Paribas freezes redemptions in their mortgage-backed securities. Go into 08, March 16th of 08, JP Morgan acquires Bear Stearns for $2 a share. Later revised to 10. July of 08, IndyMac Bank fails, making it one of the largest bank failures in history. September 08, Fannie Mae and Freddie Mac placed into government conservatorship. September 15th of 08, Lehman Brothers files for bankruptcy, $639 billion in assets. September 16th of 08, AIG received an $85 billion bailout from the Fed because it wanted to prevent a systematic collapse of the financial system. September 29th of 08, Congress rejects its first TARP bill, causing the Dow to plunge 778 points, the largest single-day drop at that time.
Question for you. Do you think September of 2008 was, based on everything that has happened in the market and the economy throughout history, do you think that was the most challenging time? I mean, I know for your career it definitely was. But
so the reason I'm highlighting this in this fashion is
that's
you literally were on the brink of a complete and total collapse of the entire financial system. Banks didn't trust each other, right? You had so many programs that were considered to be bulletproof that were showing that they weren't. And at any point, I think going back to the late 30s, there was a time when you could have completely been in a Great Depression for a very long time period. Mm-hmm. It was that bad.
Yeah.
I mean, when you sit there and you have the three big automakers in November, GM, Ford, Chrysler, pleading for government aid, right? October of 08, the 6th through the 10th, the worst week in the stock market in history at that time. The Dow fell 18% in a week. You look at this, look at 09. You start going in early 09 in January, unemployment was 7%. You know, you had the S&P bottoming in March. And so here's my point with this. You have bearish indicators right now that are telling you things are as bad as they were back then, okay? So the market is nowhere near close to the environment that I dealt with back during the GFC. I feel investors' personal political views are bleeding into their investor sentiments as well as concerns about tariffs being overblown. Could the market be right and things don't go well for the economy as the year goes on? Of course, that's a possibility. But in my opinion, I wouldn't make that my base case. But it seems to be, especially over the last 3 or 4 weeks, the market seems to be doing so. Your comments?
Yeah, I think, depending on what indicator you look at, sentiment is shockingly
extreme
where it is. I mean, if you just look back at history with how negative people are on the market and the economy right now, and we didn't know what the market was doing and we just saw these sentiment indicators, I would have thought that the S&P was down 30%, 25%.
Well said.
Right?
Well
Not
said.
10% from the highs.
Yeah, well said.
So, yeah, it's an interesting point.
You know, our podcast is time-stamped. You know, for newer listeners, you can go back and listen to what Mark and I were saying, right when COVID hit. And you and I at the time had a very unpopular contrarian view that the markets were going to recover in 2020. And at the time, I could argue, if the podcast were even bigger than it is, that we would be ridiculed for that view. And in retrospect, we nailed it. So now you have a time period where bullishness, it's hard to find some bulls out there, okay? And I think that we are projecting in a narrative of the other side of the market that is really not popular right now. I'll stand on that hill. I'm fine with that because I think when you look back, is volatility going to remain? Yes. But I think when you look 6, 12, 18, 24 months down the road, equities are attractive if you have a long-term time horizon. So that's just my personal opinion on the topic. Last point, high yield bonds. High yield bonds are not showing much concern about the economy related to stocks. This post was from Joseph Wang, and he posted this on March 11th, Mark. And what it is, it's credit spreads. And so Jenna will put up this chart for our YouTube viewers. But let's take a quick step back, and I won't be long with this, but what are credit spreads? Credit spreads represent the difference in yield between two bonds of similar maturity but differing credit quality. So typically it's the gap between how much corporations are having to borrow money at compared to the risk-free rate of a U.S. Treasury. When those differences get really dramatic, it's the market wanting to be compensated for the more perceived risk in the economy. Right. Guess what? You're not seeing much of a premium right now on corporate or high yield bonds. Last point, going back to the great financial crisis, which sentiment levels were equal to that, you had credit spreads that literally blew out. Mm-hmm. People were getting forward-looking yields on bonds if the company didn't go bankrupt. 12, 13, 14, 15, 16%. Mm-hmm. Crazy numbers back then. So again, not comparable in my opinion, but the market could end up being right on this. But I don't think so personally.
Yeah, it's a good point. Yeah, there's a lot of good pieces I think that we had this week. So moving on to the financial planning topic of the week to wrap up. This was an article from Denise Appleby with Morningstar, also with commentary from kitsis.com. titled How to Fix Misleading Reporting on Clients' 1099-Rs. So tax season is upon us, Matt. So we have a little less than a month until the tax filing deadline on Tuesday, April 15th. So I thought it'd be good to review an article that might help clarify some things for investors, specifically regarding their 1099-Rs, which ultimately just shows how much money was withdrawn from their retirement accounts and whether that amount is taxable or not, right?
Yep, correct.
So they start off by saying, since the IRA custodian, which, custodian is a financial institution that holds client money. As a reminder, me and Matt or your financial advisor usually are not holding client money because we had Bernie Madoff back in the day.
Sure. There's always an independent custodian holding the money.
Right. So think of your Schwabs, your Fidelities type of firms.
Well
right?
said. Mm-hmm.
Since they don't have the full information about the distribution, this form could be misleading and could require corrections to be made when the client files their tax return. So when you take money out, Fidelity has no idea what you're doing with that, right? Mm-hmm. You could be spending all of it to go on a trip to Europe, or you could be taking it out and donating it, right?
Putting it in another retirement account at another custodian.
Correct. So, an example of a misleading entry on a Form 1099-R can occur when clients engage in what we call in the industry a 60-day rollover, as the IRA custodian is required to issue a 1099-R for the amount distributed, even if it was subsequently rolled over into another IRA within the 60-day window. So again, a 60-day rollover allows you to withdraw money from your IRA and redeposit it into the same or another IRA within 60 days without penalties or taxes. Mm-hmm. So you can only do this once per 12-month period across all of your IRAs. Mm-hmm. And if you miss that 60-day deadline, the withdrawal is treated as a taxable distribution and could be subject to a 10% penalty if you're under 59 and a half.
Yep.
So this is a common practice, Matt, that we see with clients who are closing on buying a house and they're waiting for their house to sell or to get the proceeds from their house sale, right? And they know, hey, I know I'm going to have the money within 60 days, but they just need like a stopgap to get them through a month or a month and a half or something, right? So that's a common scenario that we see. So they say to ensure non-taxable treatment of the rollover, the client's tax preparer would report the gross distribution amount on Form 1040, line 4A, the amount not rolled over, if any, on line 4B, and write rollover next to line 4B to let the IRS know the reason why the amount is excludable from income.
Yep.
Another example is clients taking advantage of QCDs or qualified charitable distributions during the year can follow a similar process to ensure they receive the appropriate tax treatment, entering QCD besides line 4. 4B, and again, QCD, qualified charitable distribution, where essentially older investors can elect to send all or a portion of their required minimum distribution to a qualified 501c3 so that they don't have to pay taxes on the distribution. So kind of killing two birds with one stone. If someone's charitable and also wants to reduce their taxable income and they don't have a need for the money they're required to take out of their account each and every year.
To throw it out there for our listeners and viewers, Taylor Ledbetter on our team has an active blog on the Jessup Wealth Management website. As you were speaking, I looked at the history of her blog post, and on October 5th of 2023, she had a very detailed blog post titled Required Minimum Distributions and Qualified Charitable Distributions. So if the term QCD or Qualified Charitable Distributions piqued your interest, I would encourage you to go to the Jessup Wealth Management website, click on the Tailored Finance blog, pan down, and you'll see that post again in October of 2023 if you want some more information.
Yeah, thanks for bringing that up. Taylor does a great job writing blog posts on financial planning topics. So yeah, I'd encourage people to check that out if you haven't. Well, I think we'll leave it there for the week, Matt. Anything else before...
End of the quarter's coming. Always tends to be some volatility. And then I know I sound like a broken record. We got Q1 earnings season 5 weeks away. So that also is going to be, I think, a popular narrative as we get deeper into April, because we're going to hear really how these companies are performing.
Yeah. It just seems like earnings season keeps getting closer and closer together, and that it never ends. But we'll be back in the thick of that here in probably the middle of April when banks start reporting. So,
well said.
Well, thanks everyone for listening to episode 292 of the Independent Advisors Podcast. We will be back with you next week for episode 293.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.